because everyone kept thinking like VC dump equals going down. It's not because it's VC. In the end of the day, there's more marginal sellers than buyers. Simple as that.
It's really just like dating. If you're seeing a hot girl, then you have less power. But if you're the hot guy, then you have more power to do what you want.
Welcome everyone to our Real Question Series episode 3, where we talk about crypto VC. Have they been building the industry or just extracting from it? If you've been around the crypto space for the past 5 years, you'll notice that most projects that launched during this time did an enormous amount of fundraising. Just to name a few, Goldfinch raised 36 million back in 2022, led by A16Z. Fast forward to 2026, they already shut down the project. Story Protocol, another example. They raised $140 million back in 2024, also led by A16Z. Their founder left the company last year to pivot to AI instead. I think their token peaked at $14 or something, and nowadays it's only 0.29 to 0.34, somewhere around that number. They changed their name to Data Network in 2026. But that doesn't change anything. The metrics have been horrible all around. And then we also have another example, Vera Chain raised 142 million back in 2024. I think their TVL was peaked around 3.35 billion shortly after their 2025 mainnet, and then it collapsed. Token is also down 90% from their launch highs. Those are just some few examples. There are a long list of projects that shut down after they received funding. Can name a few. There a few of them actually just launched past couple of years. Of course, there's Monad, there's Mega ETH, there's Sei, Sui, and a lot more. These are all projects that received a lot of money. They raised a lot of funding, right? And they have little impact to the ecosystem itself. And whenever you map out these projects, right, the same pattern emerges every time, whether it's an L1 project, whether it's an L2, DeFi, GameFi, it doesn't matter. So the pattern is always, the first one is they raise at a high valuation during narrative peak. They incentivize activities through airdrop promise. They launch token at an even higher valuation. They deploy ecosystem fund to manufacture activity, and once the incentive drops, the activity collapses, their team pivots, they reduce their headcount or goes quiet, and then retail is left holding with a token that no one wants to bid. So this contrasts with the projects that were built pre-2020. If you take a look at Ethereum, they raised only 18 million in 2014 through ICO from early believers. And then we have Chainlink raised 32 million in 2016 through ICO as well. And then we have Aave raised 16 million in 2017 through ICO. And then Uniswap raised 65,000 through Ethereum Foundation grant, no VC. And then the most recent one, of course, we have Hyperliquid. They are one of the most amazing project with amazing growth. They're the best perp DEX in the crypto space right now. They're the most efficient company that generates billions of revenue with only 15 employees, I think, and not one VC back then. So this raises a question, of course. Does VC actually puts value for crypto, or are they just extracting from it? Is it like a negative signal whenever a VC invested in a project? Is it a negative signal for the retail? So these questions needs to be answered. And to help me answer these questions, I have Marco here. He's an ex-VC from Primitive Ventures. And I have Lambro, who's a DeFi practitioner, and he's also an expert in analyzing projects. So Marco, I have a lot of questions, but I want to start from the ground. What does a VC actually look for when they decide they want to invest in a crypto project? Walk us through the thinking process.
I think the biggest difference that you're seeing in the past 2 years compared to now is that venture has always been about 100x return, right? 1,000x returns. Like, it's a power law game, basically. Like, if you have 300 million under your management and you have one unicorn, that can pay back your entire fund, basically. So that has always been their business model. Like, they will bet on a lot of companies, and then if just one really hits, then that would pay for the entire fund. I think the concern that the crypto VCs have seen in the past 2 years, unlike in the prior cycle, when you see so many altcoins going 100x, 50x, 30x, even 30x, helps, right? And like crypto, the liquidity cycle is so much faster. So your token will be liquid within 12 to 24 months, unlike traditional Web2 VCs that have to wait 5 to 7 years. So because that premium has been going down in the past couple of years, it has been very difficult for crypto VCs. And second, a lot of the projects these days are actually much more cash flow based. So you see a lot of projects where basically it's the same form of an exchange, basically. Like whether it's like a mobile trading app that's a builder code wrapper, or a prediction market builder code wrapper. Like all of this is really basically just you take a fee by facilitating transaction or like speculation, right? And like that over time, because the infra to build those has been going down, it becomes cash flow business. So the founder might make something really amazing that makes him $1 to $3 million a year, but for the VCs, like, oh, if I'm managing 200 million, like this is not the type of business that I want to invest in, because they need to be able to be a bit like worth $1 billion so I can get my money back. So right now I feel like there's a bit of a friction, or not really friction, but the VCs are starting to rethink how they would invest in crypto companies. That's why you're seeing more and more VCs investing in more of like these FX, like on-chain FX cross like settlement, blah blah, because they need to target a really big TAM, right? To like argue that, hey, one day if this company facilitates $1 trillion in cross-border FX volume transactions because they use on-chain technology, and because it's faster, it's cheaper, then they might be worth a couple billions and they might be acquired by Visa, and I would make my money back. But if it's just another like trading app, how can I make my money back? The founder might be rich, but I would not get like anything. So right now there's almost like this weird, there's this weird consideration that the crypto VCs need to adjust to the new reality, I would say.
So, how does a negotiation between a VC and project usually go? Which side usually has the more negotiating power? Like, how does the negotiating work?
I'll be very quick with this. It depends. I mean, if you are a very famous, successful founder with some exit, or you have a certain sugar daddy that already found your like seed round, then you can demand a much higher valuation. So it's really just like dating. If you're seeing a hot girl, then you have less power. But but if you're the hot guy, then you have more power to what you want. So I mean, I'll give you like a very straightforward answer. Yeah, yes, of course there are like industry standards in terms of like multiple. For like something like a trading app, the multiple is such and such. If you're a DEX to predict, but most of the time the founder premium is really there. Yeah.
I've always been curious for this question, Marco. Does VC make money on all of these projects they invested in? If not, what's the win rate?
No, I mean, the answer is no. Like, I don't have the exact stats right now, but you can find it online. Again, it's the power law. So they would lose money on like 90+% of the projects that they invested. The unique thing about crypto VC, why everybody wanted to be a crypto VC from 2017 to 2022, is because unlike traditional Web2 VC, they can typically get some money back because of the token. In the traditional like Web2 venture capital landscape, you would almost always lose everything. But in crypto, even your worst investment might still get you some money back, right? You might like break even, or you might get 50% of it back, which was unheard of. That's why like all the richest people in the space right now were basically like two guys and a firm, and who were crypto VCs from 2017 to 2022, because that was sort of like the gold mine if they were able to do like anything. But like now it's getting harder. So the answer is no.
Okay, I'm going for the big question. Marco, why do you think that most tokens invested by VCs are almost guaranteed to go down? It's almost like a negative signal for project's quality. It's like a negative signal for retailers to not entry. What do you have to say about that?
It's because of flow. So pretty much everything in the market is supply demand, right? Like that's why there is a joke in crypto, like fundamentals don't really matter, because fundamentals in the short term get triumph over flows. So flows basically mean, if there were seed round investors, Series A investors, whose token's going to get unlocked 12 months after the token generation event, then you would almost always see much bigger selling pressure compared to the buying pressure. You can even see this in actual like traditional stocks. Like let's use like SpaceX as the most recent example. SpaceX has a low float, high FDV, exactly like most tokens, right? And one of the reasons that Elon is trying to make sure that when the unlock happens for SpaceX, that the price doesn't fall too hard, is by making NASDAQ include them in their index via fast track, right? So they get a lot of passive buyer. That's why Bitcoin is still kind of okay. And that's why when the ETF first happened, a lot of people were like very bullish. Oh, look, we will have like passive flows to like Bitcoin, blah, blah. But for altcoins, where's the passive flow? Like no one is really buying an altcoin, especially after it just launched. Like sure, people might buy to like trade the first week post launch, but 6 months after that, it's just down. It's just down only until all of the supplies are getting rinsed. And then eventually you would see a bottom like 1, 2, 3 years in. That's why like the older tokens like Aave, for instance, right? They're like float is like 90+%. So that's why they're like they're trading better than the newer tokens because yeah, like all of the tokens have been circulating. But then again, even for the older tokens, that doesn't necessarily mean that there are buyers, right? Like you've seen like the Uniswap token. They recently said that, yo, we make tens of millions from like the Robinhood chain launch, but if you see the fees, basically it's like nothing, right? So yeah, you have to look at the details also. But the main answer is flow.
I want to go to Lambro for this next question. So most of these VC infested projects, they used airdrop to inflate their on-chain activity during testnet. This made the projects looks promising because it attracts a lot of attention. It attracts a lot of activity during testnet usually, and it made the project kind of look bullish. The community grows really fast, but in a way, they also attracts the wrong crowd because people are doing this activity just for an airdrop. I mean, we've seen a lot of people getting a life-changing money from airdrop, 5 digits, 6 digits. But yeah, I mean, after they launch, people who already received their incentives, they receive the airdrop and then they no longer use the chain or use the protocol. So the activity will then collapse post-launch. Do you think airdrops are broken or projects are using it wrong?
I think there's a few layers to this. First off is why is there airdrop? Secondly, why are people farming the airdrop? Airdrop is a great tool to bootstrap initial users, but a lot of teams, most teams use airdrop metrics to raise money. So that's why they're very willing to give out things to boost metrics to raise money or boost metrics to gain revenue. And then whether they can sustain, let's say, sticky growth or not, it's not a measurement that people can use, right? Basically, you can say like airdrop is printing token out of thin air, but someone's got to pay for it, right? Like, and how sticky and how much the campaign will be, you won't know. A perfect example is like Hyperliquid, right? Like its airdrop, yeah, it gave a bunch of tokens, but the airdrop did not dump that much in comparison to our project. The stickiness, right? Like all those things makes more sense. Whereas like most projects that are not able to get like a true PMF beyond airdrop. So I think that's the key framing on it. It's just airdrop is a campaign. How sticky it is still depends on the product. And most VC does not know or does not value how sticky will they be, or they have a way of exiting before proven unsticky of some sort. So I think that's why people over dump on airdrops, but or blame it on the airdrop farmers, but it's actually just a open market that project one airdrop farmers to come, boost their metric, raise some money, hopefully get some PMF or trim whatever money they have left in the treasury or token somehow.
I want to know about your personal opinion as well on this, Lambro. You're a degen as well. You aped into a lot of stuff. Would you invest in tokens that already raised millions or hundreds of millions from VCs?
Yes, I would, because in the end of the day, it's about marginal buyers. Like if Hyperliquid raised 10 mil, I would have bought it, if that makes sense, right? Like essentially you're just calculating is there more inflow than outflow? Obviously, most of the case has been quite extreme in crypto because of, let's say, valuation or marginal buyers, etc., etc. But like the VC project was pumping for a very long time, right? Solana was a VC project. Avex was a VC project. All these pumped. It's just because of the current market, there's more marginal sellers than buyers. Simple as that. And then people are trying to blame it. Oh, is VC token? It's not. In the end of the day, there's no one gambling. There's not enough gamblers. That's why like VC coins are dumping. It's not because it's VC. That's why we pump. You can, yeah. It's a supply control in the end of the day, right? And then if you think there's a bigger inflow than outflow, you should gamble it. But this is the perfect things that you should lock in and look for, right? Because everyone kept thinking like VC dump equals going down. But if you want to make money, this is like the small places where you try to find a misconception in the market.
So you're saying it's not about whether VC invested on it or not. It's just purely about demand. We're talking about demand here.
Yeah, that's what I think, right? Like, cause like we have too much vaporware that no one will buy, plus their VC fundraisers. And then there's also like Hyperliquid, which the distribution is worse than VC because they gave out like what 40-50% of the token, but still pumped, right? In the end of the day, is their marginal buyer. It does not matter who they are and what they do. Well, it matters because you're trying to predict when they're going to sell, right? But like in the end of the day, it's about buying what would others buy, and is that bigger than whoever will sell that flow, and then that's just a gamble.
Well, that is it for the real question for today. If this got you thinking, or if there's anything else that you want to ask us next, do send it over, DM us on X, drop it in the comments below, or hit the link in the bio. The best questions come from you, and the next episode might be yours. We'll see you on the other side.